Hi everyone, Jim Crimmins here from Traders Accounting. Before we start, I'd like to take a sound check. If you can hear me okay, please put a Y in the question box. Very good, thanks so much. Traders Accounting is located in Phoenix or in the Phoenix area. We're a tax firm that's been in business for about 20 some years now, dealing with active traders in the stock market. Today we're going to talk about what you can do to increase the money you have to trade with. And we're going to be talking about, well, the pros and the cons of trading as a business. Some of you may have heard a webinar like this before put on by someone else. I just need to throw a caution out there. If you have, it depends on who the webinar was presented by. There's a lot of false information out there, not only on the web, but in some webinars. Today, we'll talk about only things in the vanilla area of the IRS code. And we have to do that because we hope to do your taxes one day. We specialize in doing the taxation for traders. And if I gave you some information that was false and then you hired us to do your taxes, I think you'd be just a little angry. I would, I know that. So everything you hear today is in the vanilla area of the code. And I have to apologize to begin with. I have a bunch of sinus today, so every once in a while I may have to click off and clear my throat. We always need to start with the disclaimer. Take a minute and read it, if you will, please. This webinar will be recorded, and if you'd like to receive a copy of it, you should send an email to the address that's on the screen at this time, learn@tradersaccounting.com, and just put in there to please send you the PowerPoint program for this particular webinar. Our website is tradersaccounting.com. If you haven't been there, I highly recommend you go there. A lot of free information, a lot of good information. We also have a newsletter that comes out every 2 weeks, and you can subscribe to it on the website and also see what our future webinars will be on. I am a trader as well as an accountant. And I know as a trader that my number one job is cash flow. Because what I found over the years is it's a heck of a lot easier to trade with more money than it is with less money. And if that's the case, then as traders, all of us should be concerned about our cash flow. And we should listen to webinars like this that will tell you how you might be able to increase the cash that you have to trade with. Because everything you can do to maximize your cash flow is very important to you. Now, those things would all, they would include becoming a better trader. All of us want to do that. They will also include, though, a lot of other areas, trading psychology, and accounting and taxes. All of these things can help you to maximize the tax that you have, or the tax deductions you have. Now, I want you to know before we begin that the new tax law really takes aim at investors, and we'll talk about that a little bit more. The one key fact that you should understand is your largest expense as a trader is taxes, whether you make money or lose money trading. Now, I know you can understand when I say when you make money, your biggest expense is taxes, because in our antiquated tax system, the more money you make, the higher the percentages you're going to pay in taxes. Doesn't seem quite fair, kind of seems bass-backwards to me. But how can I say when you lose money trading that your largest expense is taxes? Well, for most of you, you have to understand that when you lose money in the market, the IRS will only let you deduct $3,000 of capital loss in any 1 year. So let's talk about Sally Kumquat. She was a first-year trader last year in 2017. She ended up the year losing $13,000 in trading. If she can take $3,000, it means there's $10,000 of that loss that she cannot take in that year. Now, if she's in the 25% tax bracket, I hope you can see that had she been able to take the full amount and deduct it from her taxes, she would have had another $2,500 to trade with. And that's what we're talking about, doing the things that will give you the ability to increase your cash flow. Now, I'll show you a way later that you don't need to worry about that $3,000 loss rule. But your biggest and most important job is protecting your cash flow. As a trader, you have the choice of trading as either an investor or as a business. Now, if you do nothing, the default point is an investor, and all of us started out there. However, if you're an active trader, filing your taxes as an investor is not a very smart thing to do, particularly in light of the new tax laws. Now, you can also choose to trade as a business. It's tax efficient and has other benefits, and we will talk about the various businesses that you could trade as and why one would trade as one and not as another. I did forget to tell you, if you have questions, I love to get them. I won't interrupt the program to answer them, but at the end of the program, I will answer all the questions you have. That said, if you have a question that you don't want the rest of the group to see, you can always email me at learn@tradersaccounting.com. Now, both of these positions, the investor and the business, are legal, but only one is beneficial, and you are the only one for you that can make the decision to move from being an investor to being a business. Now, I told you a moment ago that the new tax law really came down hard on investors, hobbyists. Because if you're an investor, that's what the IRS considers you, is you're just exercising a hobby. So the most recent tax reform really did a trick on hobbyists, which means to me that you need to focus, if it's possible, to make your activity a business and not a hobby. And that's what we will talk about today. And the area I've got at the bottom there that's highlighted, this is very important. The only way out of being considered a hobbyist is to take your activity and form some type of a business. Now, it may not be possible if you're not active enough as a trader because the IRS has rules about who qualifies and who doesn't qualify. We'll get into that in just a moment. Now, if you have concerns about whether you would qualify as a business, you need to call us. You can get a free consultation and we can tell you whether you qualify or don't qualify. Now, when I say incorporate, I am saying really form a business for your trading activity. Now, there again, we'll go through each of the types of businesses in just a minute here. But why does it make sense to trade as a business? Well, the first thing is you don't have any IRS reclassification issues. This has to do with hobbyists, that the expenses that you try to take on your tax return are reclassified as hobbies and unavailable to be taken. If you're trading as most businesses, you have a much lower IRS audit rate. You can deduct all of your business expenses, and this is bigger than you think, folks. We'll go through the expenses that you can deduct just in a moment. If you were to trade in a C corporation and you had a personal loss for a couple, 3 years and you decided trading wasn't for you, when you liquidate your business, if it was set up correctly to begin with, you're able to take those losses and move them into a personal loss and deduct it from your taxes. A C corporation also has a medical reimbursement plan, which is huge for a lot of people. We'll talk about it later. The biggest key of trading out an entity is asset protection. Now, we don't think about that a lot, but in our society today, where you can get sued for anything or for nothing, we need to worry about that, particularly if you are a profitable trader, because as you're profitable, your pockets get deeper and deeper and deeper, and people have a tendency to sue those people who have money. If you trade out of an entity, they can't sue the entity for anything that you or your family has done personally. And that's how you protect your assets. That's just another benefit of trading as an entity. Now, what kind of business should you set up? I don't know. Some of you have heard that it's a cookie cutter approach. If you set up an LLC in Wyoming, Nevada, or Delaware, you're never going to have dandruff or athlete's foot again. But that's not true. Each type of business will bring benefits to you and take benefits away from you. So it's up to you to decide which of the types of businesses would grant you the most tax efficient benefits so that you can increase your cash flow. Excuse me just for a moment. Starting out with the sole proprietor, it's called trader in securities. Many of you have heard that. And contrary to popular belief, you don't have to declare anything in advance. You just merely file a business tax return, a Schedule C for a sole proprietor, which becomes part of your 1040. Now, the advantages of trading as a sole proprietor, if you qualify, is that there's no cost to set it up, and you get to deduct the expenses. The disadvantages of trading as a sole proprietor is there's frequent audits. and there's no asset protection. Limited partnerships, LLCs, and S corporations are all considered to be flow-through entities. And what I mean by that is that the profit or loss flows through the entity, which actually pays no federal tax. The taxes are paid by the people that own one of those three entities. For a limited partnership, it would be the partners. For an LLC, it would be the members. And for an S corporation, it would be the stockholders. Now, limited partnership is a great entity, but it's kind of antiquated as far as trading is concerned, because in a limited partnership, you have a general partner and the rest are limited partners. The limited partners have no say-so on what's going on, except once a year they get to vote to see if they're going to keep the same limited partnership. If you've ever been in an HOA, you understand what I'm saying there. Now, the advantages of the limited partnership are the deductions of expenses, and you have asset protection. The disadvantages are the fact that the general partner is liable for any asset protection. The LLC has become the go-to entity, and I would say of the people I talk to every week, probably 60 to 70% of them would be better off in an LLC. Now, that's not saying that you'd be better off. These are people that I've talked to, that I've asked 14 questions of, and then we decide which is the most tax efficient for you. But an LLC, again, a flow-through entity, you get to deduct the expenses, you've got asset protection. Now, one of the disadvantages that I've listed here is that if you're trading in an LLC, you need two members of that LLC. You need to form a partnership. And the reason for that is that if you're trading as a single member LLC, the IRS considers that a disregarded entity. So you bounce back to the sole proprietor. Now, two members is not hard to get. A husband and wife, even if they filed jointly, can be a partnership. If you don't have a spouse, a sister, mother, father, brother could be it. Or if you don't want to involve anybody else, hey, it's easy to set up a management trust. Once it's set up, until you make about $600,000 or $700,000 a year trading, you don't have to worry about taxes or tax returns. So an LLC with two members is a very, very good entity. It doesn't have the advantages of a C corporation, however. And I know most of us have been told throughout our lifetime that if we have a C corporation, that it's going to be doubly taxed. Now, that's not entirely true. The only time it's doubly taxed is if you declare a dividend. So with a C corporation, you can deduct your expenses. You've got the asset protection. You've got a lower tax rate with the new tax rule, 21%. And you've got a medical reimbursement. And let me explain that to you now if you don't know what I'm talking about. It is a written document that your board of directors has decided to do, which allows the C corporation to reimburse whomever the board of directors has decided for all of their out-of-pocket medical expenses, which includes any insurance, including social, Medicare or Medicaid, any deductibles, any co-pays, anything that's not covered, prescriptions the same way. And you can even deduct some over-the-counter medical items that you buy in the drugstore. Now, how does it work? Well, first of all, when I say your board of directors, generally I'm speaking to people that are going to set up a family corporation. And what this says is, okay, we've got mom and dad and maybe a kid or two that are on the board of directors for the C corporation. So the C corporation board of directors decides to have a medical reimbursement plan. Once that document is written, then each month you personally pay for your medical expenses, and at the end of the month you go to Excel and download one of their templates. It's expense report. You list all of your out-of-pocket medical expenses you've had for that month and attach the receipts. Hand it from your left hand to your right hand, your left hand being you, your right hand being the treasurer for the C corporation. And the C corporation then can write a check to you. Now, the beautiful thing about this, it is a deductible expense to the C corporation, and it is not considered to be income to you. Now, that's great. So let's go through these. Now, an S corporation, I'll go through real quick. Not a real good idea to trade out of an S corporation. There are specific reasons you would use it, but unfortunately, the tax rules for an S corporation indicate that a reasonable amount of the profit has to flow out of the S corporation as payroll to the shareholders. Now, that doesn't sound bad till you remember what you also get to pay when you pay payroll. 15.3% for the feds plus the state payroll taxes. With an LLC, you don't have that problem. Now, let's go through them and pare them down. What kind of a trader would use an LLC? Well, like I said, about 60% of the traders I talk to, that is the best entity for them to use. It's the most tax efficient. Because when you trade in it, again, all of the profits or losses are going to flow through to you personally. Now, they will flow through in the same manner that you have selected your accounting method. What I mean there is that if you've taken mark to market, it will flow through to you as ordinary income or ordinary loss. If you haven't filed mark to market, it'll flow through to you as capital gain or capital loss. The nice thing about an LLC, as long as what you're doing in the LLC is trading, there is no payroll tax that you have to worry about. So all of the money just flows through to you as a distribution. Now you're going to pay the taxes on the profit. So if you're in a high tax bracket, one of the things you may want to look at so you don't inflate the percentage of taxes that you're paying is to look towards a C corporation, because it's a separate taxpayer. It's a person. So that all of your profit will be taxed to the C corporation at 21%. Excuse me. Now, there is a small problem then. If you need to take money out to live on, you're going to have to pay payroll to get it out of there. But that is an expense to the corporation, so you're able to write that off. So for a high income individual, a C corporation may be something to look at. Also, if you're a newbie trader, you've still got your job, you're working, you don't need to take any money out of your entity, and you just want to build it up, well, a C corporation is perfect for you, because you get to deduct all of your expenses, you get the medical reimbursement, the lower tax rate, And you can just grow your trading account. And also the other individual that would use a C corporation is someone with large medical expenses. And the one thing I left off my list of medical expenses that are deductible is long-term care, if you're paying insurance for that. Now, an S corporation, I say it's used for specific reasons. Where I will recommend an S corporation to someone is someone that says, hey, I'm making fairly good money trading in the market. And what I would like to do is lower my taxes by setting up a self-directed 401k and contributing my profit to that. Well, then the payroll tax becomes fine, because in order to fund any type of retirement plan in the US, you have to have income that comes to you through payroll. So as you can see, there's different reasons to select each of these. And I'll tell you, it is so complicated that if it were me, I wouldn't try to do it on my own. And I see this every day. Somebody went to a seminar somewhere and they talked them into setting up an LLC in Wyoming. But actually the LLC is the worst thing they could have done for the individual. So anyway, there you have it. You know a little more now than you did before. So how do you qualify through the IRS as a trader? There's nothing in the IRS code, folks. Absolutely nothing, nada. But the IRS has come up with some special rules. And these special rules have been around for a long while. Excuse me. They've been tested in the courts. So they're in concrete pretty well. They have 3 special rules. You must seek to profit from daily market movements in the price of securities. Now, what that means is you need to be a short-term trader. Well, can you have long-term trades too? Sure. But you have to have enough short-term trades to satisfy number 2 below. Because your trading activity must be substantial. Now, the idiots, there is a tax court case from a long time ago that spelled out what that activity has to be. 338 trades in a year. Now remember, a round trip counts as 2 trades. I also advise our clients to keep a day timer on their desk or to keep something on their computer where they can track all of the hours that they spend on anything for their trading. You would use the hour that you're going to spend with me today. Because elsewhere in the IRS code, there are several instances where 500 hours is mentioned as being a key point to have a business. Now, if you're a trader and an active trader, you know that 500 hours, 10 hours a week, is nothing. You spend a great deal of time more than that. And the last one is you must carry on the activity with continuity and regularity. You can't just start it in January and end it in March because you decided you didn't want to be a trader. You will not qualify as a business. That was brought home in 2004 when we had probably one of the most famous tax court cases that we've had having to do with trading. It was Frank Chin versus the commissioner, in which Mr. Chin took $80,000, opened a trading account in January. By March, he was broke and he quit trading. Didn't file his tax return. The IRS came after him at the end of 3 years, so he filed it at that point, filing it as a business and taking the mark-to-market election. Well, the IRS laughed at him, and so he decided to take it to the tax court. who in turn, judges never laugh. So the judge just said, hey, pal, you've got to trade with continuity and regularity. You only traded for 3 months, so you're not a business. And because you're not a business, you can't claim mark-to-market. Now, why did he want to take mark-to-market? He had the $80,000 loss. If it was a capital loss, he was going to have $77,000 left on his books. And he didn't like that. If he could have taken mark-to-market, he could have taken the whole $80,000 against any income that he had. The IRS stance on business, and this is right out of their book, deductions are a matter of legislative grace, except for traders. But the key point here is that the taxpayer must maintain adequate records to substantiate the amount of any deductions or credits claimed. One of my hobbies is to look at all of the tax court cases each month. And I am shocked at how many small business people try to convince the IRS that the sheet that they have with no backup, no receipts or anything else, should make adequate records. And of course, they never win. So if you decide you're going to trade as a business, one of the keys here, and it should be being done anyway, is that when you pay to go to a seminar, you get the receipt and you keep it in your book. The next 2 pages are from an Excel spreadsheet, which I developed some years ago. And it describes most of the expenses an active trader would take. Let's start down this list. Organizational expenses. If you decided to set up an entity through Traders Accounting, let's say you came to us and you say, I want you to set up an LLC for us. Well, the cost of setting that up is deductible. That's the organizational expense. When you set it up, we recommend that you sell all of your office equipment to the entity. Why? Well, it's got to be sold at fair market value on the day you sold it. But now you can deduct whatever that fair market value is. Cash flow, folks, cash flow. The big one is you get to write off all of your startup costs. Now, these are investigatory costs. And what it is, you can go back some 12 to 15 months, accumulate all of the business expenses you've had for your trading during that time, and you can write it off. The tax law changed a couple of years ago. You can write off $5,000 the first year and then amortize the rest and write them off over I think it's 180 months. But $5,000, if you're in the 20% tax bracket, there's another $1,000 to trade with. And you'd already spent that money anyway. Automobile expenses, not so much, but it's 54.5 cents a mile. So if you drive your car to a Denver trading meet, if you're in Denver, 54.5 cents. If you go to the airport to fly out to meet with your mentor or to take a seminar, write it off. If you're going to go to the airport to go to the Traders Expo, write it off. Payroll, we only recommend payroll for 2 different classes of people. Number one, I already described to you, somebody wanting to fund a retirement account. The other one is if you've got teenage kids at home that you're paying an allowance to, there's nothing on the IRS form that allows you to deduct that allowance. But if you can come up with a legitimate job for your kids and you're teaching them how to trade, pay them a salary. They can make, I think it's $10,000 and there's no taxes for them. The qualification for a pension plan, that's where I mentioned high income people want to cut their taxes, so they set up a self-directed 401k. not one like Fidelity or the other brokers advertise. That's not a self-directed 401k. It's self-directed to the extent that you can do anything that they have. But a truly self-directed 401k makes you the custodian. You make all of the investment decisions. You can invest in almost everything. You can decide to trade any way you want to. You can invest in real estate. You can invest in Uncle Guido's pizza parlor if you want to. You are the custodian. You make that decision. That's a truly self-directed pension plan. If you want to talk about it, be more than happy to chat with you. Office equipment purchase. I know you've been wanting one of those strings of 6 or 8 or 12 screens. I'm not sure how anybody can keep track of all of that, but you're a better man than I. But that's deductible. Home office deduction. Now, people have poo-pooed that for years, but it's legitimate. The IRS even has pamphlets to tell you how to go about it. And I would say our average client deducts about $2,000 a year on that. And remember, that's money you spend anyway. Any bank service charge, your office supplies. The big ones are at the bottom. The hotels, meals, and travel if you go anywhere for a seminar or to the Traders Expo. Now, if you'd like a copy of that Excel spreadsheet, won't cost you a dime. Just email us, learn@tradersaccounting.com, and all you need to do is put slides in the subject window and we'll send it out to you. But make sure you've got Excel on your computer because you can't open it if you don't. Here's another one that you can get for free. It's the new rules on meals and entertainment. It changed drastically with the new tax law. This will tell you what can be deducted, how much of it can be deducted, etc., etc. If you'd like to get a copy of this, do the same thing. Learn@tradersaccounting.com. Put meals and entertainment expenses, or just expense sheet in the, no, don't put expense sheet because you'll get the other one. Put meals and entertainment, and then you get this one. I talked about how big the write-off of investigatory expenses is. This is the rules for the IRS. You can deduct up to $5,000 of startup and $5,000 of organizational, and then you amortize the rest. I've had clients that have legitimately turned in almost $50,000 on startup. These were people that really love to go to seminars. I need to mention wash sales. I hate to mention wash sales. It's my least favorite subject, but if I don't, somebody's going to ask me about it. Now, this only pertains to people that are trading stocks and or options and or cryptocurrency. And we're not sure about cryptocurrency because they're still writing the laws on that. But I've been to many, many seminars put on by very smart people trying to figure out this new rules. And we all agree that you better be aware of wash sales if you're trading crypto and go ahead and take them. And there's a lot of other rules that you should be aware of. One of the webinars I do is on cryptocurrency. You might check our website and see when that's scheduled. But a wash sale, if you own a position and sell it for a loss and buy it back within 30 days of selling it for that loss, or had you taken a short position 30 days before you sold it for a loss, you do not get to take the loss. Now, the reason they're called wash sales, in my opinion, I made this up, is that sooner or later they'll probably wash out. But if you can't take the loss, let's use an example. You own Microsoft at $30. And everything you look at says, hey, it's going down. So you're able to sell it at $28. You've got a $2 loss. Now, if you take that off your taxes and you got 1,000 shares, that's $2,000 of loss. And you'd be able to take it. And if you were in the 25% tax bracket, you'd have another, what, $500 to trade with. But since you can't take it, if you bought it back within 30 days after you sold it for a loss, that just stays there. There is no loss. However, eventually it'll wash out, because what it does, the loss goes away, but it changes the basis of the second time that you sold it to include the loss you had in the basis. So eventually you'll be able to get out from underneath the wash sale. However, if you're trading in November and December, be very, very careful, because you may not be able to have time to get out from underneath the wash sales. The biggest swing that I know of was one of our clients several years ago who ended up having a $50,000 swing because he traded the same 4 stocks all year long, and everything he did had a wash sale to it. Now, if you trade as a business, we can elect out of wash sales, and I'll tell you how in a minute. Well, that minute's here. Mark to market, it's an accounting method, folks. Just like in school we were taught, if you took an accounting class, there's cash accounting and accrual accounting. But there's also several other types of accounting, and they're normally industry specific. And for traders, it's called mark to market. Now, it's an election that you've got to take in paper by writing to the IRS. It converts all capital loss or capital gain to ordinary income. How do you get it? You send a letter to the IRS no later than April 15th of the first year you want to use it, or 75 days after you set up a new entity to trade in. What type of trader would use it? Trader that's trading stocks, options, or crypto. What type of trader would not? Generally, someone trading futures or Forex. Okay, you convinced me, Jim. I'm going to set up a business. Where should I set it up? 99 times out of 100, the best thing you can do to set it up is to set it up in the state you live in. Now, there's 3 states that are marginal when I say that, but Nevada is not one of them, folks. Nevada is one of the most expensive states you can set it up in. And there are people who teach seminars that indicate you should set it up in Nevada. The reason being is called the ka-ching factor. You're right, K-A-C-H-I-N-G, ka-ching. It's a Scottish word. Anyway, the reason they're telling you that to set it up there, or Wyoming or Delaware, is that when you set it up in a state you do not live in, you have to hire what's called a person that is going to get your mail, and anything that is legal mail, sign for it. It's called a resident agent. The reason the ka-ching factor comes into play is they want to be your resident agent. they're going to charge you anywhere from $400 to $800 a year to be a resident agent, and you'll probably never even hear from them. When you set up your business in the state you live in, you are your own resident agent. As an accountant, I would never badmouth any other accountant. But accountants do come in many flavors. And they'll be the first to tell you, when I first moved our business to Phoenix, I don't know how many years ago now, it was many, many years ago, the office next to the office that we rented had an accountant in there. And when I walked in to introduce myself, we got to talking. I told him we specialized in traders accounting. He says, well, that's great. I specialize in farm accounting. So there are accountants that do different things. In fact, if we listen to the news this week and last week, we heard of one accountant that lied. Anyway, some accountants know about the taxation of traders. Most don't. And the reason they don't is economic. They may have one or two traders in the number of returns they do. Now, if you're going to become an active trader, you should go to your accountant if you have a relationship with them and ask them, tell them what you're going to do. You're going to become an active trader. Do you feel like you're qualified to do my taxes? Not only the accountant, though, I think this is Crimmins 1-on-1 here, that a serious trader should have a good broker, one that's a broker that specializes in what they're doing, that has good rates and quick access, a good mentor who will work with you, and a good accountant. Somebody will say, yeah, but that's going to cost me money. Yeah, it's going to cost you money, but it may save you more than you're going to spend. As an example, on the accounting side, each year during this time of year, we get people that ask us to look at their taxes to see if they were prepared right. And I would guess that 5 times out of 10, if somebody is trading futures or Forex, the taxes have been done wrong, they've been put on the wrong schedule, and it's cost the taxpayer some serious bucks. So make sure you find a good accountant. Now, I really appreciate your attending. I want to remind you that you can get a free 30-minute consultation. What we'll talk about is your trading, tell you whether you could qualify as a business or not, and if you can, which would be the most tax efficient for you. Write that number down that's there, 855-334-7936, and give us a call. Now, I am going to get my question box out. It'll take me just a minute, and I will answer any questions that you might have. Oh, looks like we got a good group today. Good group. Okay. Philip said I was garbled and breaking up. I'm sorry. Carl says, if I trade just futures, which are taxed differently, the most option or equities, can I deduct the commissions and network fees and just report the net income without being incorporated? Carl, you can. I'm not sure about the network fees, but you certainly can with the commissions. Now, if you want me to look up network fees, send me an email. learn@tradersaccounting.com. Harmeet. Hey, Harmeet, how are you doing? In an LLC partnership with the C corporation as what Harmeet here is talking about is a combination entity. I happen to know that he uses the C corporation as a management corporation and the LLC to trade in. In this setup are the long-term capital gains and dividends from stock investments classified as active income on the K1. Yes. Ting says, hi, Jim, I'm using a C Corp, but I have incurred huge trading losses. I set the C Corporation up with you. Thank you, Ting. And he's retained us to do his bookkeeping and his taxes. Thank you very, very much, Ting. Anastasia says, where is the contact information? It was on the first slide. Anastasia, it's, why don't I try to go? Well, I can't. Maybe I can. I'm going to buzz back through these slides real quick. There's the contact information for you. Stanton says, flow through LLC or sole proprietor if you don't elect mark to market. I don't know what your question was, Stanton. C corporation, doesn't someone who is on a medical reimbursement plan have to take Stanton, the rest of your question didn't come through. I am going to guess that you're going to say, doesn't someone who's on a medical reimbursement plan have to take a salary? No. Tony says, I just retired in July. I have no income, thus no contribution to Social Security. Should I start taking my Social Security payout? I'll be 68 in September. There's two different ways to look at that, Tony. Some people say you should wait as long as you can, and some people say grab it as soon as you can. I don't know anything about you, so I couldn't comment. Ting says, what should I do with those trading losses? Ting, that'd be a better thing for you to call us. I'd be more than happy to discuss it with you. Thanks so much for being here. There weren't that many questions. I hope you learned something today, and I'd love to talk to you about your trading activity. Be sure and give us a call. 800-938-9513. Thank you.